If the auditors have a tricky client and inherent and control risk are high, then detection risk must be low. The only way to reduce detection risk is to increase the work carried out on the audit. More audit procedures would be needed. More time should be spent on the audit. Sample sizes should be increased, and even more experienced audit staff should be used to help detect material misstatements. If the client is a fairly stable one with no previous or current issues in a non-risky industry, then detection risk can afford to be a little higher. This does not mean the auditor relaxes the rules when carrying out the audit work, as they still must follow auditing standards and ensure they have collected sufficient appropriate evidence to form their independent opinion. What it does mean is that they can afford to test smaller samples of transactions and therefore spend less time on the audit in comparison to a more high-risk client. The audit risk model is key to understanding audit risk. The three components, inherent risk, control risk and detection risk, identify the overall risk of the auditor forming an inappropriate opinion on the financial statements. Remember that the nature of the client's business and industry and the quality of their control systems could cause material misstatements, and these risks must be identified by the audit team at the planning stage. They then need to decide on the level of acceptable detection risk. For detection risk to be low, more audit work and time spent is needed by the audit team. This all then helps decide on the audit procedures needed to be carried out and the key financial statement balances that need most focus. If audit risk is assessed correctly, the audit opinion will be appropriate at the end of the process.